Hello everyone, and welcome to the 2025 Northbound Wealth Management Halftime Report presentation. We're delighted to see all of you here and look forward to sharing some vital economic and market information with you. Let's dive in. But first, I want to draw your attention to these disclosures. Please take a few moments to review and we'll go from there. Today I'm going to focus on four key areas. We're going to, number one, review the first half of the year. Number two, take a look at potential market forces in the second half outlook. And number three, ask, where are we now? And finally, we'll take a look at what's ahead for the second half of 2025 and beyond. Now let's begin by reviewing how the stock market performed during the first half of 2025. Here is a snapshot of the S&P 500 index from January 1st, 2025 to May 30th. The S&P 500 initially rallied and then declined over this period overall, impacted in part by the administration's new trade policy, which we all know. The first half was marked by three overriding themes: post-inauguration enthusiasm, trade updates, and then trade relief. After the administration launched a new wave of tariffs, stocks fell in early April on concerns that tariffs might cause inflation, which might influence the Fed's decision regarding short-term interest rates. A rebound began after the White House announced a 90-day pause, and stocks rallied further after the US and China struck a deal to temporarily reduce reciprocal tariffs. We use the chart of the S&P 500 Composite Index because it's generally considered representative of the US stock market. Index performance is not indicative of past performance of a particular investment, and past performance does not guarantee future results. Individuals cannot invest directly in an index, and the return and principal value of stocks will fluctuate as market conditions change. Shares, when sold, may be worth more or less than their original cost. So we've talked a bit about the S&P 500 performance so far this year, but how does that performance compare to expectations? At the end of the year, various media outlets compile some of Wall Street analyst predictions for the year ahead. This table shows several projections shared at the end of 2024, and we covered that at the State of the Markets at the beginning of the year. How do these predictions compare to reality so far? The S&P 500 closed at 5,882 on December 31st, 2024, and at 5,912 on May 30th, 2025. And we're well above that now. We're in the 6,300s record all-time highs today, actually, and this is July, the end of July. Through the first 5 months of 2025, stock prices have fallen short of predictions from these six leading Wall Street firms. Even the most pessimistic forecasts in this table represent an increase of just over 10% for all of 2025, but in reality, the market has barely moved from where it was 5 months ago. The outlook reflected expectations that the economy would likely continue growing or that tariffs would have had more of a muted impact. So just so you know, we're at 6,300 now, so it has gapped up and the market has moved in a substantial way. Those Wall Street analyst predictions look even less reliable when you look at how many financial institutions lowered their price targets between the end of last year and April 24th of this year. And by the way, they re-looked at them and reevaluated them looking now that we're at record highs for the end of the year. They're actually increasing those price targets again. But estimating where the S&P 500 will be by the end of the year is always challenging, especially this year, given the uncertainties of trade policy, inflation, and global economic growth, not to mention central bank moves around interest rates like the Fed and other global banks. It's worth repeating that the S&P 500 Composite Index, again, is an unmanaged index, generally considered representative of the U.S. stock market. So the top 500 companies in the United States. In the following slides, we'll discuss the factors that may impact stocks in the second half of the year. And I know you can't see all the indicators on here, but to create some context about where the economy may go in the second half of the year, let's start by looking back to June 2024 so you can get a better perspective of how quickly the outlook can change. We picked June 24 because it was a few months before the presidential election. If you guys can remember that, it seems like a decade ago. Back then, roughly 1/3 of economic and financial indicators were positive, including inflation and the labor market, with only 2 negative: valuation outlook and geopolitical risk. 9 months later, 4 indicators had turned from neutral to positive: monetary policy, the U.S. economic outlook, fiscal policy, and business outlook spending surveys. Housing mortgages slipped from positive to neutral. This was after Inauguration Day, but before the White House began implementing a new trade policy at the start of April. In 3 short months, there's more concern about the economic outlook. And it seems like there always is, climbing some sort of wall of worry all the time. There are now 16 indicators showing a neutral stance compared with 11 a year ago. The takeaway here is that indicators can change quickly, but despite all the uncertainty around trade policy, forward-looking indicators like these can change again, especially if trade deals continue to be resolved. This chart shows the relationship between changes in the S&P 500 Composite Index and the 12-month forward earnings per share, or EPS. As you can see, the 2 lines have generally moved in the same direction over the past decade. Because the stock market is a discounting mechanism reflecting what investors believe the economy will look like 6 to 9 months in the future, stock prices can and at times change more quickly than earnings growth. When determining monetary policy, the Fed is tasked with supporting maximum employment, stable prices, and moderate long-term interest rates. As it works to uphold its monetary policy goal, one of the indicators monitored by the Fed is the overall level of consumer prices, which it helps determine whether to adjust interest rates. The Fed has stated that it's comfortable with inflation in the 2% range. If we ever get there, we don't know, but we'll see. The charts we're looking at depict consumer price inflation on a year-over-year basis and a month-over-month basis. As you can see in the chart to the left, year-over-year inflation slowed in the first quarter of 2025, but the consumer price index still remains above the Fed's target 2% inflation rate. Expect the Fed's decisions on monetary policy to continue to influence the financial markets through the second half of the year as more clarity emerges on tariffs' impact on inflation. And the Fed is going to be talking this week about that. And so we'll see what happens. The labor market continues to demonstrate its resilience. This vitality has provided important support to the markets since having a job is foundational to consumer spending, which helps drive economic growth. This strength may be best illustrated by 2 labor market measures: current job openings and the unemployment rate. While the number of job openings has fallen since its post-COVID peak, the percentage of companies unable to fill open positions remains elevated compared to the 2016 and 2020 period. The unemployment rate, meanwhile, continues to remain at historically low levels thanks to continued private sector hiring. These are just 2 of the indicators economists use when measuring the health of the labor market. Tariffs are certainly not a new thing. The idea of taxing imported goods goes back more than 2 centuries in the US alone, but it has been a market buzzword for the past few months. To keep investors informed, the S&P 500 companies are providing updates as part of their quarterly conference calls with investors. As you can see in the chart, on the first quarter calls of this year, shareholders use the word tariffs were mentioned by 411 of the 500 S&P 500 companies' CEOs. Investors want to hear how tariffs are affecting companies and how they are adapting their business strategies accordingly. Now let's examine the present before we dive into what the future may hold. Let's take a moment to consider the variables that may weigh heaviest on the market performance during the second half of 2025. The first is trade policy. Markets hate uncertainty, and trade policy has certainly introduced plenty of that in the first half. Stock prices have tended to react to White House updates on tariffs and possible deals being worked on. Some fear that trade policy might influence interest rates. The Federal Reserve has stated repeatedly that they cannot make a call on changing monetary policy stances until they have more clarity on how trade policy will impact inflation and employment. Another variable is the overall economy. The Fed is engaging in a balancing act between managing inflation and the job market while supporting economic growth. As we move into the second half, we may see which side tips the balance. Finally, will artificial intelligence dominate headlines again? I think so, but we'll see. Of course, no one can predict what can happen in the future, but we hope the following perspectives can help you understand what we believe may be on the horizon. And finally, let's look at potential forecasts for the second half of the year and beyond. The overall level of economic activity may play a role in how the financial markets perform in the coming quarters. To gain a better insight into how economists think the economy will perform, we take a look at the May 2025 survey of professional forecasters conducted by the Federal Reserve of Philadelphia. Let's look specifically at the consensus forecast for three key economic factors that may influence the market's perception of the state of the economy: GDP growth, unemployment, and inflation. As you can see in the charts, the consensus view as of May 2025 is that GDP, or gross domestic product growth, is expected to be between 0 and 1.4% in 2025. Meanwhile, professionals are projecting that the unemployment rate will creep up to the next bracket between 4.3% and 4.8%. These professionals also expect inflation as measured by the core personal consumption expenditures to be between 3% and 3.4%, up 2 brackets from last year. Remember, forecasts are based on assumptions and subject to revisions over time. Financial, economic, political, and regulatory issues may cause the actual results to differ from the expectations expressed in the forecast. I expect them to change as we go through the next several months, and we'll see where they end up at the end of the year. Some market strategists look at the bottom-up earnings per share report or data to help them set their price target for the S&P 500 index. When setting a bottoms-up EPS or earnings per share, market strategists focus their attention on estimating earnings for all S&P 500 companies. By contrast, a top-down investing target price places a greater emphasis on macroeconomic factors when making an investment forecast. The chart shows the bottoms-up EPS and the price of the S&P 500. A word of caution that this type of analysis should not be seen as a perfect indicator of stock price performance. We've gone over that several times. In this chart, notice how stock prices have been trending flat to higher while corporate earnings are more mixed. When evaluating this chart, it's important to remember that the stock market is considered, again, as a discounting mechanism, which means that it's always looking forward. Put another way, the stock market's price today represents all available information about current and future events. How far forward is the stock market looking? Most would agree it's discounting activity 6 to 9 months into the future. So are stock prices seeing a turnaround in earnings? That's uncertain and only time will tell. Here are a few things to keep in mind. Again, past performance does not guarantee future results, and you can't invest directly in an index, and the principal value of stocks and market conditions can go up or down and change. So keep that in mind. Okay, considering the importance of corporate earnings to stock valuations, the big question for investors is, what can we expect for future corporate earnings? If you take a look at the chart, you'll notice that the earnings for 6 out of the 11 industry sectors of the S&P 500 are expected to grow compared with today. Third, from the left on this chart is the overall earnings growth projection for all S&P 500 companies, estimated to be 5.1%. Do you guys see that? So some sectors are expected to do better while others are projected to lag according to FactSet data. So we're just looking at that. So how long will inflation stick around? Well, future progress on managing inflation may be a bit more difficult. One aspect of inflation in particular focus for the Fed as well as market analysts and economists is what is called sticky inflation. Sticky inflation refers to the components of the CPI or the Consumer Price Index that have historically exhibited a greater rigidity or stickiness with respect to price changes. In this chart, 12-month sticky inflation is the orange line, while the 12-month CPI is the gray line. Sticky inflation includes many service-based categories, including medical services, education, and personal care services, as well as most of the housing categories. Fed Chair Jerome Powell has often referred to stickiness and service-related inflation as one reason for remaining vigilant in the Fed's fight to lower inflation, keeping interest rates higher rather than lower. As you can see in the chart, while the Atlanta Fed's measure of sticky inflation has been stubborn, it has moderated over the past year or so and has moved closer to flexible CPI. Needless to say, the Fed has much to consider as it evaluates monetary policy. Among the biggest questions investors have heading into the second half of the year are, will the Fed adjust interest rates before the end of the year? And does the Fed see rising inflation or slowing labor market as a bigger threat? So which areas of the economy are most prone to higher inflation? The next 4 meetings of the FOMC, or the Federal Open Market Committee, may answer some questions and provide additional clarity for investors. The FOMC is scheduled to meet 4 more times in 2025. In fact, they're actually meeting today, July 29th through the 30th. Then their next set is September 16th and 17th. Then again in October 28th and 29th. And then December 9th and 10th. Typically, if the Fed's going to make an adjustment to interest rates, it may announce the change following their 2-day meetings. Only in extraordinary circumstances does the Fed announce changes to monetary policy in between meetings. So we'll keep an eye on that for you. Here's another relationship to understand. Bond prices and bond yields have an inverse relationship. So in other words, when bond yields go up, existing bond prices go down. Those are the bond market dynamics. After experiencing years of low interest rates, some investors may be surprised to realize their bonds can lose money if sold before they reach maturity. And bond values may decline during periods of rising interest rates. But a changing tide in the economy doesn't mean you have to abandon fixed income allocation altogether. Often, this movement is an important part of a well-balanced, diversified portfolio that may provide investors with the income they need. However, keep in mind that there's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification is an approach to help manage risk. It does not eliminate the risk of loss if a security price declines. So here at Northbound Wealth Management, we focus and stay focused on fundamentals, but we also look at technical analysis as well. But tuning out headline noise while managing your finances is not always easy. However, wise investing involves more than reacting to headlines that may discuss consumer sentiment or geopolitical developments. For investing opportunities, one approach is to stay focused on the fundamentals. like a company's earnings or economic data. Bull and bear market trends. We've gone over a lot today, but I'd like to conclude with a longer-term perspective on the financial markets. Having this perspective, I think, is key when pursuing the financial goals we've set for ourselves. Lately, there's been a lot of volatility, but despite that, we are up on the year across the board, and in the U.S. markets and technology, and actually in the foreign markets are doing well. And this chart shows an analysis of bull and bear markets during the period from 1942 through the first quarter of 2025. Here we see that the average bull market lasts more than 51 months. On the other hand, the average bear market has run a little over 11 months. As we can see above, the rewards of growing an innovative economy often go to investors with the discipline to remain invested over the long term. Remember, investing involves risk, and investment decisions should be based on your own goals, time horizon, and risk tolerance. The S&P 500, again, is an unmanaged index, and you can't directly buy it, but you can buy securities that are like it, and we do that here at Northbound Wealth Management. And past performance does not guarantee future results, and prices fluctuate, so you got to be ready for that. One final note: it may be helpful to remember that volatility is part of the investing process. The table shows that more than 7 times a year, investors should expect pullbacks of 3%, and at least once a year since 1928, investors should be prepared for a 10% correction. That's not a crash, it's a correction. When viewed from a historical perspective, market volatility isn't abnormal as one might think. I know it's uncomfortable when stock prices pull back or slip into correction territory. Financial media can take the day's events and make them seem overwhelming, which can cause some investors to lose focus on their overall strategy. But when markets start moving quickly, remember this chart. It may help you manage your emotions. Declines are basically a natural part of market cycles. We've gone through a lot of information here. I'm sure you still have lingering questions. Remember, if you're wondering something, you can always reach out to us at Northbound Wealth Management. You can call us at 317-399-1107 or go to our website at www.northboundwealth.com and send us a message through our Contact Us form. And we'd be happy to chat with you and discuss your specific and unique situation. Thanks so much for your time today. As you can tell, I'm passionate about helping people understand the markets. For more information and timely updates, please follow us on social media. Contact us anytime, and we hope you enjoyed the details that we shared on this presentation today.